Our next guest runs an investment firm that is up over 25% on the year. Joining us right now with his outlook on the market and some stock picks is well-known fund manager and value investor Scott Black. He's president of Delphi Management, and he joins us now from Boston. Scott, good afternoon. Great to have you back with us.
Thank you for inviting me, Carol.
You know, Scott, we're talking an awful lot about this jobs report today. You know, the administration saying that August is the least bad month for job losses in a year. Republicans obviously have a little bit of a different take here. What is your take on the monthly job report today?
Well, I really don't think Obama's done a very good job. If you want to harken back to the 1930s, Franklin Roosevelt used to say the best social program is a job, and when he hit the ground running in 33, he created employment. It may have been called WPA and NRA, but yeah, we're still bleeding. And I know you alluded to it earlier. It's actually called the U6. There's roughly 16.8% of America is unemployed at this point, and that's not good. And I don't think we're going to get much of a recovery until we start putting Americans back to work.
Scott,
that's my opinion.
Scott, we learned yesterday that we've already given out almost $100 billion of the stimulus money. Why haven't we created jobs? I mean, what happened to the shovel-ready projects that we had all set up?
Yeah, they were on the books there in the States, but they haven't been funded. We own companies in that area like Fluor and Matrix and Jacobs and smaller companies that do business, and we've called these companies, and they haven't seen a nickel of spending yet. And there are construction jobs to be had. Of the $787 billion stimulus program, approximately $45 billion was supposed to go for infrastructure, and very little has been spent to date. And although not everybody who went to college wants to drive a truck, you know, these are good-paying jobs for construction workers, and they create demand for aggregates, cement, and structural steel, and we haven't seen a nickel of spending really going in that direction.
Hey, Scott, so what do we need to do to really get people back to work, in your view? Because I'm concerned. I'm looking at the equity market. It's had quite a rally. There's a lot of optimism out there, but certainly no optimism for those people who don't have jobs. And I'm thinking about consumers and how important they are to the economy. So what do we got to do here?
Well, I do think we have to have some government spending that will direct towards the areas that we talked about, with infrastructure to build bridges and highways and the electrical grid. I'm not convinced that big business is going to stop putting people back to work. They've made earnings per share by cutting the middle lines, SG&A and direct overhead, direct labor, and those people are going to be loath to putting people back to work in a rush. When you lay off 10 or 15,000 people, whether it's a Boeing or an Emerson Electric, it's very hard for small companies and ones and twos to make up for that gap.
You know, Jim Grant says that we are spending 10 times the amount that we would typically spend in a post-war recession as far as stimulus goes. Don't you have optimism that this money, I mean, the rest of the $787 billion, obviously still coming due, don't you have any optimism that this money is going to somehow come down to consumers and help them deleverage the way they need to?
Not really. I think a lot of the money is going for transfer payments for people who are unemployed. And yes, they're going to defend their standard of living. To some degree, they still have to buy groceries, pay the rent or the mortgage payments. But to a large extent, the discretionary spending is going to be cut way back. And if you look at household debt as a function of GDP, where it is today relative to the Clinton years, to get back to that ratio, you would have to unwind over $4 trillion worth of consumer debt, which doesn't bode well for spending in the GDP and a rebound.
All right, Scott, I want to go back to the markets with this, because I know you were on with us in July. I think you were talking to Pim Fox. You were surprised at that point by the strength of this rally. We've had such an enormous rally. We're up about 50% from that March low. At this point, does it make you nervous, the move that we've seen?
Not really, because I'm always fully invested. We don't try to time the market, but from a pure valuation standpoint, the market is expensive. The S&P is a little over 1,000. The earnings are about $54 for this year on a bottom-up basis, $44, $45 on a top-down economic basis. That puts you at a market multiple somewhere between 18 and 22 times expected earnings. The market is not cheap by any metric at this point. And when you do microeconomic screening, which we do, there are very few cheap stocks left.
Does that mean you expect a pullback here, Scott, or do you expect at least a sideways move from here?
I'm not smart enough to tell you. There's too much liquidity outside the market here in treasuries that could push the market up. And from a standpoint of true valuation, it's full.
All right, Scott, sit tight. We're going to come back and talk some more with you. We are talking with Scott Black, president of Delphi Management. All right, everybody, we are back. We're talking with Scott Black, president of Delphi Management. Hey, Scott, Craig Torres out in D.C., Bloomberg News is saying, can you ask Scott if his companies are getting the credit they need or if their customers or consumers are? What are your thoughts there?
to ask each company you call, especially if they have debt on balance sheet, whether they have access to credit, who they bank with, when the banks roll. So it's a case-by-case basis. Most of the companies we own have clean balance sheets, and those that have slight leverage have access to credit at this point.
What about consumers, though, Scott? We talk so much about the lack of credit available for consumers. Is that a good or bad thing? I mean, I know consumers were so over-leveraged before, but at this point, is the lack of credit for consumers a really bad thing?
Well, it will be for the rebound in the GDP. As you well know, over the last 10 or 15 years, consumption as part of the GDP of America has been between 2/3 and 70%. And the fact that we're deleveraging the balance sheets, the savings rates goes up, means we're probably going to have a shallow recovery. I wouldn't expect much in the way of the consumer leading this recovery.
You know, I wonder if we can talk about some individual stocks here. I was watching your show. Carol and I both watched your show with him. And you like Jack in the Box there, which is an interesting one. Obviously, a consumer-driven stock, but one that maybe you expect to see consumers choose as they step down. Is that the case, and do you still like it?
We still like it. It's hovered around $20 a share. As you know, they're basically selling off a lot of their company-owned stores to franchisees and buying back the stock. So there's not a lot of top-line growth, but there's earnings per share growth and lots of free cash flow. They do about 24% return on equity, 12% return on total capital. And because they have what you referred to as the low end of QSR, quick-serve restaurants, people have been trading down to them and the McDonald's and the Burger Kings. It's been beneficial. The other thing is they've gone to a healthier menu. It's not all fat and cholesterol the way it was 10 years ago.
Hey, Scott, in the auto group, though, back in July, you also talked about owning Toyota. You thought it was cheap and a great play on the recovery. You still like that one as well?
We do. It's only about 1.3 times tangible book value. Obviously, they have a dominant worldwide share. The only other player in the world that I think that's very good with scale is probably VW. The U.S. companies, to a large extent, a basket case, is kept in the game for employment benefits. But the bottom line is Toyota is a terrific franchise.
You know what I thought was cool? I heard you say that before, and I checked it out. Toyota's up about 5% since you said that in July. Volkswagen shares down more than 50%. Is this a play that you can arbitrage? I mean, do you cash out a Toyota here and buy into Volkswagen, or is the share price action there totally obscured from the Porsche merger?
Yeah, I think that's it. We don't own Volkswagen, but they've done a pretty good job over the last few years. And, of course, amongst the luxury cars, even though their volumes are down, BMW is a well-run company as well. But I wouldn't be buying either BMW or VW.
Hey, some other names that you like, Scott. One is DynCorp. The ticker, I believe, is DCP. It's outside of Washington. Stock's up about 12% so far this year. What's the thinking here on this one?
Well, they have a solid backlog, over $6 billion. It's up year over year. They have a top-line growth rate of about 12% with no merger and acquisition. There aren't that many companies that have top-line growth. The stock is around 17. If you look at next year's calendar year, they'll earn about $1.75, $1.80. It's a 9 PE. The margins are at a record high at about 6.1%. They have a well-funded backlog. 95% of it's the U.S. government. They actually benefit to some degree with the pullout of the troops in Iraq because they train the security forces in Iraq. They're also in Afghanistan. They manage things like Andrews Air Force Base, Air Force bases at the United Arab Emirates. It's a solid company that nobody's ever heard of.
So any cuts in government spending on defense wouldn't bother you here as far as the stock is concerned?
It's interesting. I asked that question. They're not part of the procurement budget. They're part of the maintenance budget, so they don't get hit with the Raytheons or the Boeings or the Lockheeds. It's a totally different portion of the TOA.
Hey, Scott, there was some significant selling earlier in August. Stock was down, I think, 13% on August 6th, 8% down on August 5th. So a buying opportunity for you that when you see some dips in this name?
Yes, we just started buying the stock in the past week and a half, and I've spoken to the management, and I think it's a decent company. I owned the company almost 20 years ago, had a different mix of business, but I still think they know their business and they'll benefit from what's going on with the Department of Defense and global security. They also do things like narcotics trade to make sure that they have people that oversee that area. They're into global linguistics. In fact, they supply people who speak 26 different dialects of Arabic in the Middle East.
All right. Scott Black, thanks so much for joining us. Pleasure to have you. President of Delphi Management there, Scott Black.